Welcome back. Glad to have you here again. Chapter 7 includes a detailed look in the assets section of the balance sheet, more specifically at receivables. Once again, I'd like you to make sure you understand the learning objectives for the chapter. They are here and in the chapter checklist for your review. Remember that receivables increase with a debit and decrease with a credit. While some businesses accept cash in exchange for merchandise or services performed, most companies agree to accept receivables as a convenience to their customers, sometimes just to keep up with the competition. Ideally, we would prefer to receive cash up front, wouldn't we? Why is that? I think we all agree it is because cash is a sure thing, and anytime we agree to wait for our cash, there is some risk involved. Risk, that is, that we may never collect on the receivable. Chapter 7 shows us how the accounting system accounts for the fact that we will not collect all the receivables that are owed to us. We will also learn about notes receivable in Chapter 7. Accounts receivable is usually listed at just below cash and short-term investments in the current assets section on the balance sheet. And that is because it is a relatively liquid asset and is paid in cash within a short period of time. So where do accounts receivable come from? Remember, they are our customers' promise to pay us later when we have either sold them our product or completed a service for them. Although we maintain one accounts receivable account in the general ledger, called the control account, we will create a separate accounts receivable account for each customer in a subsidiary ledger. There are as many subsidiary account receivable accounts as we have credit customers. Having these subsidiary accounts allows us to track how much each customer owes us and to track all sales to and all payments from each customer, all of their activity. Does that make sense? At any point in time, we can add up all the individual accounts, and the total will equal the total in the accounts receivable account in the general ledger. Pretty neat system. Unfortunately, we also need to account for those customers that won't pay us, and we call this bad debts. Let's look first, though, at an example of selling on credit and of an accounts receivable subsidiary record. To see how accounts receivable from credit sales are recognized in the accounting records, we look at two transactions on July 1st between TechCom and its credit customers. Those will be shown on this slide. The first transaction is a credit sale of $950 to CompStore. A credit sale is posted with both a debit to the accounts receivable account in the general ledger, and the system makes a simultaneous entry to debit or increase the customer account in the accounts receivable subsidiary ledger. The second transaction is a collection of $720 from RDA Electronics from a prior credit sale. As you remember, cash receipts from a credit customer are posted with a credit to the accounts receivable account in the general ledger. The cash receipt also flows through to credit the customer account in the accounts receivable subsidiary ledger. So let's see how those postings to the subsidiary ledgers are reflected. This slide is an illustration, as many are, from your textbook. It shows the general ledger and the accounts receivable ledger after recording the two July 1st transactions. The general ledger reflects the $3,000 June 30th balance, the effect of the sale of $950, the collection of $720, and the resulting balance of $3,230. Notice the sale is also reflected as an increase in CompStore's individual customer account, and the cash receipt is reflected as a decrease in RDA's customer account. Now, a schedule of accounts receivable is simply a list of the subsidiary accounts, in this case 2 customers, and their balances. If we use it to add up the balances in the individual accounts, we see that they equal the debit balance of the accounts receivable account in the general ledger. To remain competitive, many companies allow customers to use credit cards for sales on credit at their company. An important advantage of accepting credit cards is that the risk of not being paid by the customer shifts to the credit card company. The credit card company must do the work to evaluate the customer's creditworthiness. Customers are happy to be able to delay payment, so they tend to purchase more. And finally, cash collections are quicker for our company because the selling company receives payment from the credit card company and doesn't have to wait for the customer to make a payment. Of course, in exchange for all of these advantages, companies pay a percentage of the sale to third-party credit card companies as a payment for using their services. And these fees can range from 1 to 5% of the sale amount. In most cases, the company waits a few days to be paid by the credit card company. The amount paid by the credit card company will be for the amount of the sale, less an agreed upon fee, which ranges between 1 and 4 to 5% of the card sales. American Express takes the longest to pay and charges the most, which is why some businesses don't accept Amex. To illustrate, assume TechCom has $100 of credit card sales with a 4% processing fee and will collect the net amount of $96 cash from the credit card company on July 20th. 2 entries are made. The first to record the sale and receivable from the credit card company, and the second to record the cash collected. Notice that the receivable from the credit card company and not from the end customer. The end customer owes the credit card company, not TechCom, okay? The first entry on the date of sale is a credit to sales for the entire amount of the sale of $100. However, the debit to accounts receivable is only for $96, which represents how much cash TechCom will collect from the credit card company. The $4 fee is also recorded at the date of sale under the matching principle. This is important. In this case, the fee is recorded as a debit of $4 to credit card expense. The $4 fee is what TechCom must pay for allowing customers to use the third-party credit card. When cash is later received from the credit card company, the entry is to debit cash and credit accounts receivable for $96. Your homework includes a couple exercises related to credit card sales, and you will be expected to know the process for the exam. Okay, well, that's it for part 1. See you in a few minutes for how companies handle accounting for customers who don't pay their bills.